You might think that investors would try to mislead the investment bankers by pretending to have little or no interest in the offering. If they can convince the investment bankers that the securities aren't worth very much, then they might be able to persuade them to set an offering price that's too low. The problem with that tactic is that when the securities are offered for sale later, the investment bankers will allocate them partly according to the amount of interest the investors displayed during the roadshow. Even if the investors have managed to fool the investment bankers into setting a low price, they won't get many shares at that low price because they didn't show much interest. That means they won't make much money. Telling the truth pays. There's a lot of give and take involved too. Because investment bankers expect to have lots of other deals in the future, their reputation matters, so they have incentives to treat the security buyers well. Eventually, the investment bankers will decide that they have enough information to set a range for the offering price and settle on the number of shares to be offered. They'll incorporate this information into the red herring, make a few other changes, and eventually call the resulting document the prospectus. The prospectus is an official legal document. The Securities and Exchange Commission requires that the prospectus contain the information that you need to make an informed decision about the stock offering. That's part of the reason that a prospectus is also called an offer document. Before the underwriting syndicate takes the shares to the public, it'll sometimes have a pre-IPO placement. That means that some of the shares get sold to private investors just before the IPO takes place. Typically, these private investors are big players in the equity markets. They usually get a discount from the offering price because they're buying in quantity. Some people think that's not fair to small investors. The big players counter that it's a lot easier and cheaper for the underwriting syndicate to sell 1 million shares to one private investment firm than it is to sell 1,000 shares to 1,000 different investors. Investors who buy shares in the pre-IPO placement also agree to lockup agreements. The underwriting syndicate doesn't want the participants in the pre-IPO placement to turn a quick profit by reselling their shares at the offering price immediately after the IPO itself. A lockup agreement is a legally binding contract between the underwriters and the purchasers in the pre-IPO placement. A lockup period can last for as little as 120 days or as long as a year. Probably the most common lockup period is 6 months. Some firms are willing to take the risk of pricing the shares too high and being unable to sell all of them. That would be bad because the firm won't raise the right amount of money. These firms enter a best efforts arrangement with the underwriters. The underwriter promises to make a serious effort to sell the entire issue. This keeps the risk of the sale with the issuing company instead of putting it on the underwriters. That's good for the underwriting syndicate. The bad news for the underwriting syndicate is that its fee is usually fixed. It can't benefit if the offering is a huge success. Some firms, though, aren't willing to leave the possibility of a failed offering to chance and want to transfer that risk to the underwriting syndicate. They want to know for sure that they're going to sell all of the shares at the offering price and get a specified sum of money out of the deal. Underwriters will agree to that, for a bigger fee, of course. They might enter a firm commitment and purchase all the securities directly from the issuer for sale to the public at the price specified. Or they might choose a standby agreement in which the underwriter agrees to buy all unsold shares at the subscription price. They amount to the same thing, and in fact, the terms get used interchangeably sometimes. In both cases, the underwriting syndicate can end up eating stock, as they say on the street. Investment banking firms understandably hate to eat stock. In its IPO on June 28, 2013, technology products retailer CDW had to cut the offering price of its shares to $17 from its expected range of $20 to $23 per share, right before the IPO. And that's just part of the story. CDW also reduced the number of shares offered by about 3.5 million. Coupled with the price reduction, that means that the IPO proceeds fell short of